India's exports can grow at 10% annually, provided a wide range of steps, including easier labor laws and lower real interest rates, are assured. India is planning to open another 100 airports in the next 5 years as part of its plan to revive economic growth in the country, sources tell Bloomberg News. And Reliance Jio criticizes the letter to the government from the telcos seeking relief for incumbent telecom operators in the adjusted gross revenue case, says it does not represent the industry view by any stretch of imagination. And I know what's been the talk of town, really, point number 7 in that letter, wherein Reliance is talking about how the telcos, the incumbents, are behaving, quote-unquote, crybabies. But, I think that's circulated in social media. I don't really need to talk too much about it. Let's talk about the trade setup today. It looks like the world is not an unhappy place because the US markets did reasonably okay for themselves. And the Asian screen is taking off cues from there as well. So the going seems to be okay for the time being. It has been yet another rate cut, the third, and on anticipated lines. And there's a bit of a step formation in terms of the rates thus far at the US end. The question mark only is, can it continue? And it's a difficult one to say because for now, it seems to be that the Fed would be on pause. However, can that continue? Is the question that most people have at the back of their mind, because would the economic data come out and mar that policy from the Fed? Now, time will tell, but for now, the rates have gone down, third time in this year, and let's wait and watch if there is more in store, if not in this current calendar, then over the course of the next 6 months. What does the trade setup look like then for the day? I think we've had some very good run in the last few days, and therefore, one, because it's the FNO expiry day as well, and two, because of the kind of run that we've seen, maybe, just maybe, some bit of profit booking is not ruled out after 4 strong days. Also watch out that while banks have now started to not participate as strongly as the others, today IT might take a bit of a backseat as well. There's been just such a remarkable performance in TCS over the last few days, and maybe some moderation likely post a strong surge. And while I know a lot of people are optically looking at the FI data and trying to say that the FIs have made a bit of a comeback, keep in mind that some of these numbers have bulk deals within them. This large bar that you're seeing also has a sizable contribution from the HDFC Life share sale, which was bought by the Capital Group, and therefore that shows in the FI numbers. Otherwise, it's nothing special. It's just a routine month in terms of fund flows as well. I don't think anybody can say with any kind of confidence about whether fund flows have come back with a bang in India. I can certainly say they haven't. But nevertheless, for now, people might rejoice the positive number. Let's wait and watch if that lasts. Very quickly, stocks, or what are the things that you should watch out for today in terms of results? Only one nifty name, Indian Oil Corporation, coming out with numbers. We'll watch out for that. But 2 or 3 interesting financial names coming out with numbers, including a Manappuram Finance and a Spandana Spurti, which has been trading at life highs, and therefore very important for the company to deliver its numbers. If it fails to do that in terms of numbers or commentary, then we're in for a bit of a disappointing reaction on the stock. Though the management has sounded very confident the last time they spoke to BloombergQuint, so maybe it'll last. In terms of companies that you should watch out for in the session today, extremely positive commentary from SBI. Nothing that we didn't hear in the press conference, but I think some details came out. They're guiding for a very strong second half in the analyst meet. The management is confident of sustained improvement in the core operating performance. That's the key thing. They also see improved asset quality given the balance sheet strength. Most importantly, one more point that came out is the focus on subsidiaries, and SBI Cards IPO may be the key focus and catalyst according to the conclusion of the analyst meet. So do watch out for State Bank of India. It was up 3.5% yesterday. As I said, Reliance Industries, because Jio and the way it objected to telcos seeking relief from DOT after the AGR judgment, both RIL and the telcos would be in focus. Credit Access Grameen, we'll hear the management at 9:30 today. NI up 23%, net profit up 37%, asset quality stable, gross loan portfolio up 36%. It needed to deliver on most counts. I would reckon it has done, but we'll talk to the management in detail about this performance as well. And lastly, JK Tyres and Quest Corp. 2 names, JK Tyre, the net profit jump was on the back of deferred tax reversal. Margins have been aided by lower expenses and lower raw material costs. I think raw material costs came off about 400 basis points. So Let's wait and watch for JK Tyre. As also Quest Corp, it's been a stock that's taken a significant drubbing, and the high finance and depreciation costs continue to impact profits. Let's wait and watch if the street comes out disappointed at the on open today with regards to Quest Corp. So those are a few names that you should monitor. However, let's tell you what's lined up on First Word today. It can't get bigger than the Fed meeting outcome. And we speak to Sean Matthews of Hondius Capital on what he makes of the US Federal Reserve's latest position, hinting at a possible pause on future rate cuts. I take you to the expert advisory group on exports prescription to revive exports in the country. Yash then Johnson to tell us why automakers may breathe a sigh of relief in October. Lenders have a new strategy: target customers with lower credit scores. Pallavi will tell us why, and that will sum up what the First Word looks like in the session today. Start off with the US Federal Reserve decision. They cut interest rates by 25 basis points. Unexpected lines, I would say, but Chairman Powell signaled a pause in the cycle unless economic outlook changes materially. Bloomberg's Kathleen Hayes reports.
The Fed really based, and Jay Powell repeated this today, they based these rate cuts on the fact that the U.S. economy was okay, worried about the global economy, worried about trade tensions. And today the Fed did cut the key rate 25 basis points, third time this year. That was expected. The big question is, what will Jay Powell signal about what happens next? And what he seemed to signal is we're going to wait and see. First of all, the policy statement dropped the pledge, quote, to act as appropriate to sustain the economic expansion. And then here's what Jay elaborated on when he talked at the press conference.
We see the current stance of monetary policy as likely to remain appropriate, as long as incoming information about the economy remains broadly consistent with our outlook of moderate economic growth, a strong labor market, and inflation near our symmetric 2% objective.
You know, Powell also said monetary policy is, quote, in a good place to keep the economy growing. Our Bloomberg Eco-Fed team in Washington is ready. A great story tonight where they're speculating. Is Jay Powell saying that the Fed has finally achieved that elusive soft landing, kind of Goldilocks, economy's not growing too much, not growing too little? Bottom line, the odds of a rate cut in December are down to about 1 in 5. Data will be watching very closely to determine what to decide about what the Fed does next.
Well, Sean Matthews, founder and chief investment officer at Hondius Capital Management, joins us on the phone from New York. Sean, good having you. Thanks so much for joining in. What did you make of the change of stance, and whether you believe that the data, the economic data, as you see it over the next 6 months, will not force the hand of the Fed to go contrarian to its stance?
Well, I think the Fed has always been data dependent. So now they're just expressly saying at this point in time they're data dependent. They talked about being a mid-cycle easing cycle that they had. So they had 3 eases over the last couple months. And now they're going to just sit back, look at the world, determine where the economy is. Now, the economy is getting softer, so global economy is getting softer, and that's going to be something that they're going to have to deal with. But I think right now they're at a kind of hold pace. Let's see if the world gets much weaker. If it gets weaker, we'll ease. But right now, they're in a pause scenario.
Mm-hmm. Sean, the Commerce Department saying that the economy growing at 1.9%, and I think various estimates also speak about how unemployment has continued to drop, consumer spending remaining solid, more affordable mortgages reviving the housing market. At a point of time when everybody's talking about the economy softening, would these data points have also, in a manner of speaking, impacted what the Fed would have thought?
Well, I think because they were in an easing cycle, it allowed for some of those points to be better. So the consumer is in a good position only because the employment rate is low, so that's really important to them, and that'll continue to drive their thought process to spending. I mean, the real concern is going to be your capital spending is still slow, and it'll probably continue to remain slow over the next 6 months to a year. And how does the consumer hold up if, in fact, we get a little bit of weakness on the employment numbers? And it's very possible we could see that. So I think we're in a moment in time where we could go lower, we could go higher as far as what the economy is doing. So I think it really is about looking at the numbers over the next 3 months and determining, is it a scenario where they should ease again?
Okay, data dependent, I reckon. Just a small follow-up on that, Sean, and that is in Fed's own words, that the risks associated with both Brexit and the trade tensions are showing signs of easing. What do you make of that comment? Because hitherto, the Fed has not sounded dovish on both of these.
Well, it's interesting, right? Because I think the plan that's in place, at least the China plan with tariffs, they could have probably had a year and a half ago, right? So I think now people are talking about it's looking better, et cetera. I still think we're where we were a year and a half ago there. Brexit does feel like it's getting a little bit better, but it's still uncertain. So I look at the global trade tension that's out there, and you still have, Trump talking about potentially going into Europe and talking about tariffs there. You're talking about, Asia and China where tariffs are there. So I still think it's an uncertain environment from that perspective. And though it feels better because we've been conditioned to the fact that it's been bad. And any good incremental news has been gleamed as something positive. Look, the equity markets want to go up at this point in time, so they kind of latch on to that. And they're latching on to because there's a low interest rate environment, which allows multiples to expand. So I think we're still in a kind of unique scenario where we could have a scenario where the market has moved in front of the data, and the data is essentially not much because if you look at the tariff news, it's still okay at best. And I think we're going to have to look at the next 6 months and figure out where the tariffs are. I believe this is a 5 or 10 year plan for the tariffs. It's not going to be a short-term horizon.
Yeah, and maybe while you are sounding different than the rest, maybe even you are being conservative because it could even be longer. Just one final question, Sean, and that is on your estimates of when does the next cut, if at all, happens. The bets are being pared down for the December cut. I would reckon safe assumption. What's your guesstimate?
I don't think you get one in December because I think it's still going to be too early. And as long as financial assets are doing okay, it'll be hard to justify from the Fed's perspective to actually have another cut unless you see a clear downtrend in the economy. I think they're on hold probably to the end of the first quarter, potentially the second quarter. And then it's really data dependent at that point in time. So I think they are truly neutral at this point, and they're going to observe what's going on because at the end of the day, they need bullets if, in fact, we go into a recessionary environment at some point in time. They're going to be in a position to actually cut rates and actually have a meaningful impact. If they continue to cut rates for the sake of the markets, then eventually that's going to really be a detriment to actually helping out when they need to have bullets in their gun.
Yeah, never mind what Donald Trump says or tweets. Great having you, Sean
Correct.
Matthews. Thank you so much for taking the time out and speaking with us today at BloombergQuint. All right, that's the view from Honduras capital back in New York. Not too different from what most people would be thinking about as well. No rate cuts in December, or at least the bets are pared down significantly. He believes, of course, it could go as late as second half of the next calendar, which is April, May, June of 2020 is when the Fed may act next. Time will tell. Data will tell. Back home, a government-appointed committee set up to look into India's flagging exports has recommended a slew of measures and observations, by the way, aimed at 10% exports growth each year. The committee, headed by Sujit Bhalla, has also categorically rebutted the argument that an appreciation in the Indian currency is to blame for the drop in exports. So one, they are of course saying that the Indian exports can grow at about 10% annually, allowing for the doubling of the quantum of outbound shipments, subject to a few things that exporters and government keep in mind. I mean, there are a few things or few reforms that need to be done. Labor reforms, most important to their mind, corporate tax rate cuts, and a lower cost of capital. That's one key thing, I think, in the measures that they are saying that they are recommending that should be done. Now, one thing that they are saying with regards to the lessening exports, and I quote, they're saying that the world has become a lot more competitive and inherited competitive advantages is no longer in the nature of low-hanging fruit. This is from the committee of the high-level group on exports. And why they are saying this, amongst other things, is that they believe the excuse is being given out about exchange rates and a few other factors are not the only reasons why this has happened. Of course, they also go out and say that the exchange rate is not the principal reason why this has happened. And there is data, by the way, supporting that, because they believe that on a real exchange rate index basis, the Indian rupee is amongst the most competitive. It's compiled it's as per the compilation of the Bank of International Settlements between 2003 and 2012. It was 97.1. Between 2012 to 2017, 97.8. And despite all of this, Indian exports have remained muted. The Indian rupee was one of the most competitive currencies in a sample of 60 countries. So this is, as per the committee, at best a bad and an untrue excuse and not the real reason why exports have dwindled. But of course, there are some reasons why this would have happened. And amongst other things, the cost of capital and taxes is what they say would be the real reason why this would have happened. Now, corporate taxes, they believe, are too high. And therefore, because these corporate taxes are high, the retained earnings of exporters as a percentage of their income in India are substantially lower than competitors, smaller ones at that. Though you can now argue that they are larger ones too. But Vietnam, Bangladesh have far larger percentage of retained earnings as a percentage of income because of the corporate taxes not being too high. They also believe labor reforms are the need of the hour. They are asking for, or they're saying or recommending that the labor laws need to be more flexible, which would enable the firms, particularly in the labor-intensive sectors, to scale up and scale up materially. So corporate taxes, cost of capital and labor reforms, three key things which needs to be done, which are hurting. And what can India do to push up export growth? Well, number of reforms ranging from using the free trade agreements very strategically to a systemic use of WTO, focusing on agricultural exports. Much as so many pundits are saying that India needs to move ahead from being an agriculture dominated country to an industrial one, this committee is asking to focus on agriculture exports. There are some sector-specific recommendations, and you can read about these on the BloombergQuint website as well. They were diversifying services exports beyond IT, which is a need of the hour, I would reckon. And lastly, introduction of elephant bonds. Now, for all of you who are wondering what elephant bonds are, it's a rupee-denominated bond with a 25-year maturity, largely used for infrastructure, or probably solely used for infrastructure. And they are saying this is the need of the hour as well, to finance infrastructure, which is facing a lot of issues unless there is global money willing to put in, because the domestic money, the cost of capital is just so high that it cannot finance the infrastructure project. And which is why a lot of companies, infrastructure companies, are now starting to look outwards for their dollar-denominated debt as opposed to borrowing from the Indians. And therefore, maybe elephant bonds might also help. So, slew of measures, some reasons why this can't happen, but hope that a 10% export target is certainly achievable. I urge all of you to log on to our website, BloombergQuint.com, and try and read more about this. Next piece on First Word is on automakers. They may breathe a sigh of relief. Finally, the BloombergQuint Dealers Survey conducted amongst 9 dealerships across the country shows that sales have actually picked up this month. Yash Upadhyay is here to take us through the details. Yash, it's early days though.
The dealers had told us last month as well that the month of October is going to be better than September, and that is the promise that has actually come true. So as far as individual companies are concerned, and we'll start first with Maruti Suzuki, do keep in mind that there is some amount of discrepancy because these are wholesale numbers vis-a-vis the retail figures. So there is that bit of discrepancy, but do take these numbers with a grain of salt. On a year-on-year basis, Maruti sold close to around 147,000 units last year in the month of October, which was at that point their highest ever monthly sales. So it seems to be that because of this high base, we might not see a significant jump up. But on a month-on-month basis, most of these companies, including Maruti Suzuki, they are likely to report an improvement of anywhere between 8 to 10%. So on a year-on-year basis, we could see a fall of 10% for Maruti. Next up is Mahindra and Mahindra. They too did extremely good sales in the October of last year, and on the back of that high base, we could see a correction of anywhere between 15 to 17%. Tata Motors, they have a higher share of the commercial vehicle space in their overall portfolio, and that is one area which has been under significant pressure. So on account of that, we could see a far higher drop for Tata Motors. It could be anywhere between 25 to 30% for Tata Motors, but on a month-on-month basis, again, there is significant improvement for the company. As far as the two-wheeler space is concerned, just to understand the kind of high base that we are working with, Hero MotoCorp did sales in excess of 7 lakh units in the month of October. Now that again is the highest monthly sales that they did at that point in time, and since October of last year, it has never managed to surpass the mark of 7 lakh sales in a particular month. So on that high base, again, we could see a double-digit drop for Hero MotoCorp. Next in the line is Bajaj Auto, or TVS Motors, in fact, and there again we could see anywhere between a 15 to 17% drop for the company. Bajaj Auto also did extremely good sales in the month of October last year, in excess of 5 lakh units. Again, something that it has not managed to touch so far in the last 1 year period. It is also aided by the fact that it has the higher share of exports to its overall sales numbers as compared to the other players. So that is something which has been also aiding the company. But again, a 16% drop is seen for Bajaj Auto on a year-on-year basis. And lastly, Eicher Motors, issues with respect to plant unrest and all, they have played out, but still there isn't a substantial enough pickup, and on a year-on-year basis, they did close to 70,000 plus units. This time around, it could be somewhere around 62 or 65,000 units for the company. Now, what are dealers telling me? And this is for a second consecutive month that we are hearing some positive news flow coming in. Now, this is mainly because in the month of October, we have had almost all of the festivities bunched up and coming together. So not only was the Navratras and Dhanteras, but also the Diwali, which did take place in November of last year, that has come in the month of October, and as a result of that, we've seen the positive sales being triggered. That apart, we've seen significant amount of discounts being offered by most of these dealers, benefits ranging up all the way up to 1 lakh rupees for some of the entry-level cars, having a price tag of anywhere between 5 to 6 lakh rupees. So that's a healthy 15 to 20% discount on most of these cars. One of the key issues that has been plaguing the industry over the last 1 year is the dealer inventory situation, which has been significantly higher, at least as far as the two-wheeler space is concerned. But even most of the brokerage reports and the dealers that I speak to tell that because of this uptick in demand and the conservative bookings and the order taking from the OEMs, the inventory correction has taken significantly, and now most of the dealers, they are working with inventories of less than 30 days, which is a big positive given that we'll soon have the transition from BS4 to BS6 as well. Another key thing is the steps taken by the government in the form of cutting down the interest rates. That has improved the availability of finance and lending from NBFCs and banks to most of these customers. That has improved in the form of easy down payment options and EMI plans for the customers. So slowly and steadily, the benefits of lower interest rates, they are trickling down into the system. But the most important question is, what is the outlook going forward? We've had 2 consecutive months of really good sales on a very high base as well. But while we are seeing month-on-month improvement, and probably to some extent on a year-on-year basis as well, it would be too soon to call it a revival, is what most of the dealers are telling me, because going forward in the month of November as well as December, we might see again some amount of discounting coming in, but for 2 consecutive months we've had record discounting and promotional offers run by these dealers, and that will take a step down in the month of November. So the sustainability of this demand is something that is under question. Most of the dealers don't expect this to continue for next month as well. But If what I understand from most of these dealers is correct, then even last month they told us that October is going to be better, and we saw October. Most of these dealers tell us that it has actually done well. So November may be something of an aberration, but do take these numbers with a grain of salt, because again there is that discrepancy with the retail sales and the wholesale or the factory gate numbers.
Thanks a lot for that, Yash. So that's as far as what the auto sales numbers could look like. Remember, this is the BloombergQuint dealer survey. Tomorrow we'll also get you what brokers are saying by and large, and then the numbers start trickling in at about 9:30 a.m. on. The last piece on First Word today. Faced with a slowing economy, lenders are increasing their focus on customers with lower credit scores in order to maintain growth rates. That's according to a study by credit bureau TransUnion CIBIL. Pallavi Nahata has the findings of that report.
As economic growth slows and consumption weakens, banks and NBFCs are lending more to higher risk borrowers, according to a study conducted by TransUnion CIBIL. There's a rise in the proportion of personal loans and credit cards given to consumers with lower credit scores. For instance, while new personal loans rose by 30.8%, this growth was accompanied by a marked shift in new loans to near-prime and subprime borrowers. Near-prime borrowers are those with credit scores between 650 and 700, while subprime borrowers are those with scores between 300 and 650. According to the report, 44.8% of new borrowers during the quarter ended June 2019 were those categorized as subprime and near-prime. This compared with 36.4% for the same quarter in the previous year. In the case of personal loans originated by NBFCs, almost half were to borrowers in below prime segments. This was an increase of 8.5 percentage points over the quarter ended June 2018. A similar trend also persisted across credit cards. In Q2, 32.1% of new credit cards were issued to consumers in the near-prime and subprime categories, compared with 26.4% a year ago. Overall, the number of new credit cards issued rose by 30.2% and pulled up the total number of active credit card customers to 27.7 million for the quarter ended June 2019. Outstanding credit card balances came close to the rupees 1 lakh crore mark, led by strong origination volumes. Delinquencies in these segments have improved modestly so far. While unsecured lending continued to grow, driven by riskier lending, sluggish passenger vehicle sales, and affordability constraints in housing, limited credit growth in secured lending. New auto loans originated during the quarter increased only by 7.7% over the same period last year. Even here, originations from borrowers in below prime segments rose to 37.4% from 33.1% a year ago.
That's all that we have on First Word today. Lots more lined up on Indian Open, though. We discuss markets and macros with UR Bhatt of Dalton Capital Advisors, September quarter earnings with Udaya Kumar Herber of Credit Access Grameen, and Rajiv Batra of Cummins India. But after this break, a full tilt towards the day's trade.